exciting topic today, really diving into blockchain technology and cryptocurrency. Leading the planning team, we get a lot of questions on this topic on a regular basis. And I think what we try to do with today is compile like common themes of questions and topics that we get from regular conversations with our members, and really kind of use that for the first portion as we kind of, talk things out. And then as you have questions, toss them in the Q&A section down below in the Zoom link. We'll get to as many questions as we can. Before I pass it on over to Pedro and Matt to introduce themselves, just some quick disclosures. Nothing that any of us talk about today should be looked at as financial advice. Just high-level education, guidance, things like that. Especially as we're talking about crypto, it's an extremely volatile asset class and relatively unproven from that perspective. So really need to weigh your risks with your overall preferences and things like that before you make those decisions, and we're not endorsing it. So anyways, we got the fun disclosures out of the way. Pedro, why don't you start off by introducing yourself to the group?
Absolutely. Well, first of all, thank you so much, Brian and Paige, for having us today. My name is Pedro Palandrani. I'm a research analyst at Global X ETFs. I'll talk about who we are in just a second, but I cover a variety of themes, including blockchain technology, artificial intelligence, cybersecurity, and a few others. So excited to be here with you today.
Awesome. Thanks. Matt, you're up.
Hey everyone, my name is Matt Kunke. I'm also a research analyst here at Global X. I actually just recently joined here about 7 months ago. Previously did hedge fund due diligence on volatility and crypto products. So I actually recently joined Global X to help with the crypto and blockchain effort here. And I'm very excited to be here. Thanks for having me.
Awesome. And I think, it's important to set context with everyone that's tuning in related to kind of like background, expertise, that type of thing. So, I guess, can you give us, a high level overview of, Global X as far as, that type of expertise and what you all focus on?
Absolutely, Brian. And I'm sharing my screen here just to go over a few slides very briefly. But again, we're an ETF issuer. We're actually based out of Manhattan. I'm seeing some people on the chat that are joining us from New York. So we're right here in New York City. We're currently managing $42 billion in assets under management across a variety of different ETFs. In fact, we have over 80 exchange traded funds in the market. I personally cover the thematic growth. As you can see, this is an area of significant growth for us here at Global X. That clearly includes ETFs such as in the area of blockchain technology. I mentioned a few others before, artificial intelligence, cloud computing, and a few others. But at Global X, we also have different ETFs, including in the suite of income, like covered call strategies, MLPs, and a few others, and commodities as well. We have been doing thematic investing for over a decade now. If I remember right, back in 2010, we launched our first thematic ETF. That was the lithium and battery technology ETF. So we've been in the market for many years now. We have a very solid and strong research team covering the variety of ETFs that we have in the market. And for years, we have won several awards on the ETF space. This is the overall suite of ETFs that we have on the thematic space, 32 dedicated specific thematic ETFs. And as you can see here, these range from disruptive technologies like the ones that I mentioned before, people and demographics with things like e-commerce, telemedicine, genomics, and also areas like physical environment with renewable energies, clean tech, US infrastructure development, and a few others. So I'm very excited to be here with you. Before I pass it back to Brian, I think it's just very important to understand what we mean by thematic investing. And for us, thematic investing is really about the process of identifying disruptive macro level trends, and then the underlying companies that stand to benefit from the materialization of those trends. So clearly, as you can see here, is a top-down, bottoms-up approach. And in most cases, these are long-term strategies, are unconstrained as well by geographic and sector definitions, meaning that we don't really care about the zip code of a company. If a leading company in the blockchain area is located in Canada, it's located in Asia, you name it, we want to include those type of companies in our funds. And of course, these tend to be concentrated portfolios as we try to really capture the leading companies within each of these themes. So I'll stop it there, Brian. That's a kind of very brief overview about us, Global X.
Perfect. So now I guess as we transition to go through the prepared talking points, and then hop into questions, what I'd like to do is kind of start foundational and then build up on it, because from my experience, talking with members, this is something where a lot of buzzwords and a lot of topics get thrown out, and sometimes it's important to start with a solid foundation and then build from there. So I guess first things first, in layman's terms, what is blockchain?
Absolutely. I guess I'll take that. And in the most basic sense, we think that blockchain is really a type of database. That's as simply as it can get, right? But of course, this database uses a distributed approach to collect and maintain the records within that database. And that really allows for higher degrees of accuracy, higher degrees of transparency, higher degrees of security and immutability than centralized approaches. And I think we'll talk about those in just a second. But these are properties that are opening the door to a large number of applications, even beyond cryptocurrencies, that I'm sure we'll talk about today. But just to provide some more color, if you don't mind, Brian, kind of sort of the best analogy that I can come up with is, back in 2007, when the iPhone was launched, it was really hard to predict what the best app, what the killer app was going to be for the iPhone. It was really hard to think that we were going to have the ability to ask for a ride, to get geolocation data on our phones, to jump on a social platform and connect with family and friends. It's really hard. So blockchain technology is really in the very early days, where we're going to have thousands, if not millions, of applications of the technology, but we're just getting started and seeing kind of the real potential of blockchain technology.
Awesome. I appreciate that context. And I think, it's interesting to me because especially over the course of the last 1 to 2 years, blockchain seems to get more and more attention, but can you hit on kind of a brief history lesson as far as how everything came about, when it all started, things like that?
Sure. Briefly, I guess that Bitcoin was the very first application of blockchain technology back in 2009. Again, just as a parenthesis here, any comments on Bitcoin or any other cryptocurrencies for that matter are not a recommendation. These are just comments for education and informational purposes. So again, Bitcoin, the first and most known application of blockchain, it really derives its value from the scarcity of Bitcoins, right? There will always be only 21 million Bitcoins. Of course, many of them are still being mined, but that property of guaranteeing that there's always going to be 21 million Bitcoins is really derived from the blockchain technology per se. It's not guaranteed by the developers, it's not guaranteed by the users, it's really guaranteed by the very network architecture itself. And that never existed before. If you had a large internet company 10 years ago that wanted to launch an internet coin, and they say that they were only going to have 21 million coins of that, they could ultimately change that, right? That's always controlled by a centralized authority, and these are kind of properties that blockchain technology really provide to the cryptocurrency ecosystem. And now, just as a side note here, it's important to recognize that just as email is one application of the internet, we really think that cryptocurrencies are just one application of blockchain technology. So with blockchain, you can now have things like smart contracts, NFTs. NFTs are clearly becoming a buzzword today, supply chain management, healthcare record tracking, and a variety of blockchain applications.
Awesome. So I think, one of the things that we also get questions about, which makes sense because, perceived security or just security in general is a major barrier to adoption of any, form of technology or application. I guess, how secure is blockchain and how does that relate to the concepts of proof of work versus proof of stake?
Yeah, well, blockchain technology is incredibly secure. If you look at Bitcoin per se, Bitcoin has never been hacked, right? Once the transactions are inside the network, these cannot be duplicated, they cannot be corrupted, they cannot be changed or modified, right? So these immutable properties are very powerful when it comes to security. Now, as it refers to, kind of the differences between proof of work and proof of stake, proof of work essentially requires nodes or computers on the network, all of these network participants to solve a mathematical work. This is clearly known as mining, and essentially mining verifies the legitimacy of transactions on the network. And this work is always rewarded with coins, which essentially incentivizes crypto miners to do this work. Whoever solves this puzzle first really gets the reward. Today, if you look at the Bitcoin blockchain, for example, one block is solved every 10 minutes. And the reward for that block is today 6.25 Bitcoin. Of course, this is subject to halving in just a few years, but that's a completely different topic. Then if we look at proof of stake and the difference here, although they try to serve the same purpose of verifying transactions and adding these transactions to the blockchain, the process is very different for proof of stake. With proof of stake, you have no puzzle to solve. So miners are not really competing to solve a puzzle. They're basically staking a certain amount of cryptocurrency. So you can think about this as kind of having a collateral. So then you can be assigned be the creator of a new block within the blockchain. So that assignment is really chosen from a pool of miners, and that's kind of what's happening on the proof of stake front. I guess that I want Matt to chime in here, because I know Matt is our crypto expert, and this is really within kind of the crypto ecosystem. Matt, anything else that you would add to that comment?
To be honest, I think you did a really good job. Yeah, I think at a high level, one of them is solving a computational puzzle. In order to remine an old Bitcoin block, you'd have to go re-mine all of those blocks. So it takes a lot of computational power, and that computer power ultimately secures the Bitcoin network. On a proof of stake based system, as you alluded, it's individuals that are risking their assets and their stake in the network. And the more stake they have in the network, the more likely they are to be able to produce a new block. So they're incentivized to produce a valid block because they actually get their stake slashed from them or taken from them if they're attempting to attack the network in any way, or they just go offline, or they attest to somebody else's block that's invalid. So like from a game theoretical perspective there, the people who have the largest stake in the network have the most voting power, and they're the most financially aligned to the success of the network. So it should be a disincentive for them to do anything that would disadvantage the network itself. But I think you hit it really well.
Awesome. So I think like a big theme kind of so far is like this concept, and it would be good to dive deeper on like decentralized versus centralized and stuff like that, which honestly, every time I think about it, I go back to the show on HBO, Silicon Valley, in the new internet, but that's a complete tangent that we'll go down. I guess, how does blockchain differ from, let's say, like a centralized database, and what's kind of the pros and the cons between the two?
Yeah, and kind of this is foundational for blockchain technology and cryptocurrencies, right? Essentially, the advantages of a decentralized ledger are based on the premise of trust. That's the most important thing that I think we can identify. Of course, first, all the network participants have access to a copy of the blockchain in real time. And of course, that includes the history of the blockchain. So if you think about it, you're talking about a platform that it's really fully transparent. Second, and I mentioned this before, but once a block has received sufficient confirmations, the transactions inside the blockchain cannot be duplicated. So because of this immutable nature, it can really provide superior security and traceability than centralized approaches. But of course, kind of the most important difference between the two is that since the kind of the decentralized aspect of things removes the figure of a central authority, there is no need for third-party verifications, right? So you're essentially eliminating the middleman and all the costs associated with having a middleman, or all the risk as well associated with having someone in between the network.
Awesome. So the next thing I think is kind of interesting. Earlier you mentioned that cryptocurrency is one application. You know, there's multiple applications of blockchain. I guess, can you dive into that a little bit and share some, I don't know, real world applications that are examples of these different applications?
Yeah, absolutely. I guess that, today we're in a world where supply chain constraints are top of mind for everyone, right? So blockchain can really solve supply chain issues. And that's essentially because supply chain transparency is the rule today, not the exception. So consumers will want to know the backstories of the products that we're buying, for example, right? We want to know where they're coming from, where they're going, kind of the supply chain within. So we want to have a transparent view of what's happening. These are applications that you can run on blockchain technology, having a very transparent view across the supply chain, from the time the goods being produced to the time is delivered to the retailer, and then you buy that. So those are applications that you can really have. Other applications are clearly smart contracts. Essentially, these are a set of predetermined rules by which blockchain transactions can really happen. You can think about these as, as a structure of if-when parameters followed by a then. So once these criteria is met, then X or Y happens. So smart contracts are also leveraging blockchain technology. And finally, we really think about different applications like NFTs or non-fungible tokens, for example. These are tokens that people can use to essentially represent ownership of unique items. Of course, you're seeing today in the marketplace people using NFTs for collectibles, for art, for for sports related uses, and even real estate in some cases. So these are a variety of applications that are really leveraging blockchain technology. And like I said before, I'm pretty sure that the number of applications using blockchain technology is just going to continue to grow over the next few years.
Awesome. And I think the most common question we get, or most common application, is related to cryptocurrency. And you hit on earlier, hey, Bitcoin, for example, was the first application of blockchain. I guess, can you dive in a little bit more on the connection between blockchain and cryptocurrency and the relationship between the two?
Yeah, so as you mentioned, Bitcoin was really the creation of blockchain itself. So I think using that as an example is helpful to just sort of walk through blockchains more broadly as they apply to cryptocurrency, as well as on the enterprise side. So thinking about the Bitcoin blockchain, it's a fully open, decentralized database that really just keeps track of Bitcoin balances and transactions. But if you think about this decentralized ledger technology more broadly, it can really track a lot more things. And later on, it was sort of proven with Ethereum that could be used for decentralized computation and a lot of other applications. But then on the enterprise side, it's typically being used to really just revamp database structures, gaining efficiencies by standardizing systems across multiple distinct stakeholders and providing transparency to the changes in the state of the database from end to end, where all the stakeholders can see that flow of change. But then when you think about it from a crypto perspective, it's really like the things that stand out to me as being different are, one, there's not that trust involved. So it's more pseudo-anonymous and trustless. People are really just a wallet address. And it's permissionless. Anybody can enter, they can go download the software online, they can participate in the ecosystem, unlike sort of an enterprise blockchain, which may be more of a consortium approach where it might be entirely inside one company, or it might be entirely a company and a supply chain and a few other individuals that are tied or stakeholders that are tied to it. The crypto side is fully open, decentralized. And I think the other point to mention is that like tokens are typically implemented into these systems as sort of game theoretical incentive mechanisms that can incentivize or disincentivize certain actions in order to have like this sort of closed form, fully decentralized ecosystem that operates itself.
Gotcha. So I think the centralized aspect of it, or I guess the decentralized aspect of it, leads to, I don't know, another question we get related to like, there just seems to be a lot of different cryptocurrencies out there. Like, and maybe I'm the only one that is curious about this, but like, why are there so many different types of cryptocurrency out there?
Yeah, and let me just the caveat everyone said multiple times, none of this is investment advice here. And that's a very good point, because frankly, a lot of them are pretty empty behind what you see at the headline number. I think last time I looked, it was about 13,000 cryptocurrencies. So it's a very large number. I think it's important to recognize immediately that it doesn't mean there aren't 13,000 distinct blockchains that are functional and offer interesting use cases today. A lot of these cryptocurrencies are tokens that are built through smart contracts on top of an existing blockchain, such as Ethereum, but really any other smart contract platform, such as like Solana, Avalanche, Binance Smart Chain, and really any other smart contract platform. And frankly, a lot of these tokens can just be created by any competent developer, and they can be done in sort of like a meme sense, or they can be a joke, and there can at times be not really much value behind them. And there's now even applications that can create these tokens for you, so you don't even need the technical know-how anymore to create these things. However, I would say, like, in addition to that, I know that was sort of the pessimistic view that I'm saying a lot of this is empty. There's actually a ton of really interesting things going on in the blockchain space today, with a lot more use cases than there were, say, a few years ago. The broader ecosystem is extended beyond just cryptocurrencies as a payment mechanism. To now we have crypto assets more broadly. We still have the payment side of things. We have stable value tokens, or stable coins, which are in the media a lot today. We have tokens powering smart contract platforms such as Ether on Ethereum, and Sol on Solana, and AVAX on Avalanche. And we have decentralized finance tokens. We have Web3 infrastructure tokens, and just so many more. So while there is a really, really large number of tokens, I would say there's a really large number of tokens that is not a lot behind them. There is probably still hundreds of tokens today that have real use cases that are really interesting and can be potential building blocks for the future of this ecosystem. It's just certainly not measured in the tens of thousands, as you mentioned.
Gotcha. And I think, you know, the sheer number, as well as, I guess, the age or the overall adoption rate, leads to questions about volatility. And that is a major question that we get from members that we work with. And then maybe they're concerned about the volatility compared to more traditional asset classes like, you know, stocks and bonds. So I guess, what should retail investors like the viewers on here understand or think about as it relates to the volatility of cryptocurrency?
Yeah, I'll take this, and Pedro, if you have anything to chime in at the end, feel free. And my opinion on this is that it's really just the same considerations, but more extreme. There isn't, I mean, when we're thinking about volatility, we're thinking about just going back to the starting point of like a financial advisor and thinking about like what a client needs to consider, like what are their expected returns? What's their willingness and ability to tolerate risk? What's their investment time horizon? All these important factors that sort of construct the narrative in which they should be investing. So with those questions in mind, it's important to note that crypto is a very highly volatile asset class. If you're thinking in a traditional sense of equities versus bonds, equities, you know, squared, it's a lot more punchy than even equities. So if you have a low willingness or ability to tolerate risk, or a short time horizon, it's very reasonable for you to have no crypto exposure. If you had you know, more time horizon and higher ability to tolerate risk, you know, you're maybe able to dial up a little bit on the risk spectrum. But I do think it's really a lot of those same considerations, just to a little bit more of an extreme degree. And I think just volatility in general, you just got to think about position sizing too, right? If you like the idea of the asset class, it might make sense, and you wanted it to be normally like a 5% exposure from a volatility adjusted basis. If you're thinking about like risk parity in a portfolio perspective, measuring the volatilities of all the asset classes, it might make sense to scale it down to a number, maybe 1%. And again, those are just sort of illustrative numbers, but just sort of sizing it down based on the volatility and the risk.
And I would just add to that, Brian, you know, that what we're seeing, and I'm actually going to go ahead and share my screen really briefly here. What we're seeing is that more and more institutions are actually looking at cryptocurrencies just because you can really think about these as diversifiers within a portfolio. So as you can see here on this slide, you can actually note that the level of institutional trading volume on a platform like Coinbase, of course, Coinbase being one of the leading exchanges in the market, you can see that the level of participation of institutions continues to grow over time. But at the same time, this is because, again, Bitcoin and other cryptos tend to really exhibit a very low correlation with traditional asset classes. So if your portfolio is constructed with your traditional S&P 500 allocation, or a 60-40, 60 being equities, 40 bonds, you always have that low correlation aspect of implementing or allocating to a type of cryptocurrency. So as you can see on the right hand side, the correlation, for example, the 1 year correlation between the S&P 500 and Bitcoin is only 20%. So very low correlation. And the same happens as you look across history and across different indices or asset classes like gold and oil, for example. So I think that's also important to keep in mind when we think about this on the portfolio construction side of things.
Gotcha. And I do, I guess from the financial planning side of things, a couple like key comments that I loved kind of hearing about related to goals, time horizon, your comfort and your ability to handle risk, and then, you know, the aspects of related to, you know, a lowly correlated asset, you know, compared to the rest of your portfolio. So those are a lot of the topics that we tend to touch on in one-on-one conversations. So before we're going to hop over to some audience questions here in a minute, because we got a ton of awesome questions. I guess, you know, as experts in this area, what are some ways that, let's say, you know, novices or even intermediate level people related to crypto can get started, learn, and really kind of develop that knowledge base?
Yeah, I guess I can jump in. I will say one of the really interesting things about crypto, it's probably one of the best places to start without sort of a formal education or a lot of money to spend on textbooks or anything. The entire ethos of the ecosystem is open source. So you can go read, for example, like Mastering Bitcoin, Mastering Ethereum, they're open source textbooks that you can just go find on the internet. You can join like CoinDesk, The Block, a lot of these crypto media sources produce really good content on a daily basis through newsletters. So you can go on their site and just subscribe to newsletters. And I think another key thing is just a lot of these communities have really thriving Discords and Telegrams and other sort of messaging apps. If you're interested in a particular coin or token, that's another great place to go and just like join their servers and ask questions, read the information, read the FAQ. And people are generally really receptive to providing information in the space.
Awesome. So we'll transition to questions from the audience, and anyone tuning in, you have questions, toss them on in the Q&A section. Okay, we'll transition to the first one. Oh, really good question. Can you explain how crypto prices work? Who decides what the price of a crypto token is?
Yeah, I mean, at a high level, it's going to be just supply and demand, similar to equities or really any asset class. It's where do you find the marginal buyer and the marginal seller of an asset? Crypto is unique in that there are a lot of fragmented exchanges and fragmented liquidity pools. So you often do see things like flash crashes on small exchanges at times where that doesn't really flow through into, that's not really what the market price for a token is at that point in time. It's just sort of the idiosyncratic nature of the fragmented liquidity. But it's the marginal buyer and the marginal seller. It's a lot of fragmented different exchanges. And then you also have decentralized exchanges, which are ultimately these things called automated market makers, which I won't spend too much time on, but they're basically just a price, and that price doesn't really update in real time until somebody comes and arbitrages it versus a centralized exchange. But overall, the high level answer is just marginal buyer versus marginal seller. Where do you find those price points?
Awesome. And I think for me too, that like when you're talking through that, it kind of goes back to the visual that Pedro shared related to institutional ownership, because quite frankly, the conversation about volatility, we'll see that in the equity space too, with individual stocks or companies that have low institutional ownership being much more volatile than as they have more institutional coverage being less volatile. So it's interesting that some of these things kind of feed together. All right, next question. Actually, I'm very curious about this one too. Why are there 21 million Bitcoins only? And again, we're not saying like buy Bitcoin or anything like that. It's just, it's an example.
Yeah, I mean, ultimately, they're trying to find, like, the history of Bitcoin is a decentralized currency with a fixed supply that was created and incepted at the height of the financial crisis, when people were losing trust in banks. People were scared that central banks would print away their money. So if you could build this currency that had a codified amount of inflation into it, or it's really disinflation because it's an inflation rate decreasing to zero eventually, you could present this decentralized form of hard money that you could truly trust, and that you could trust because you trust the protocol rules, and you didn't have to trust any person or government. And then from just like an actual how does it get to 21 sort of question, it starts, like, from a supply perspective, it started back in 2009 with every block, which is mined approximately every 10 minutes on average, resulting in a 50 Bitcoin block reward. So from the first day of 2009, when the first block was mined, every 10 minutes roughly 50 new Bitcoin would be created. And then every 4 years on average, that number would get cut in half. And the way it works is really, it just converges. It's this fraction that just converges to 21 million. Bitcoin can only be divided into Satoshis, which is 1/100 millionth of a Bitcoin. And you're about 2137 roughly. You'll get to a point when that block reward has been halved so many times, where it's the size of one Satoshi. And given that Bitcoin can't be cut any further than that, from that point on, that's really the last Bitcoin that's mined, and it's expected to be around 2140. You'll hit that 21 million number. I think that the number itself is a little bit arbitrary, but it's more just a fact of that finite supply.
And today, Matt, correct me if I'm wrong, but we have about 18.7 million Bitcoins mined, right? Is that correct?
Yeah, I don't have the exact number today, but it's over 18.5. I'll tell you that.
Yeah, exactly.
I'll tell you what, I really hope I'm around when that last Bitcoin gets mined in like 120 years. Okay, so next question. I guess before we hop into this question, I guess I'll kind of reiterate the house views from a planning perspective on crypto allocation and things like that. Like, reinforcing what was talked about earlier, generally speaking, like, we view it where, number one, really tolerant of risk. Number two, having the ability to experience risk, like having an emergency fund, having, your bad debt paid off, having sufficient retirement savings in traditional vehicles, stuff like that, in place before we even generally talk about allocation to crypto. Okay, so now I got the disclosure out of the way. 1 to 5% portfolio allocation to crypto seems to be fairly common, based on the risk return relationship involved. Do you see this percentage, going up, going down, and what would have to occur for changes to happen towards that kind of standardized approach?
Yeah, sure. And I guess I'll take that question. Also, I'll share my screen once again, because we actually kind of, to support what I'm going to say right now, we also ran a survey very recently, just a couple of weeks ago, where we essentially asked what's the ideal portfolio allocation to cryptocurrencies, and we got some responses very similar to this question, where most people actually still think that the right allocation to cryptocurrencies within a portfolio is 1 to 10%. Again, like you say, Brian, we can stress this enough, but it really depends on your own circumstances, and everyone has different circumstances and their different risk profiles. And again, it tends to be a very, very volatile space. However, you can see that there are some other people that do like their allocations to cryptocurrencies, generally speaking, and about 21% of the respondents on our survey say that they want to have an allocation to cryptocurrencies somewhere between 11 to 25%. That's very, very high from a portfolio construction standpoint, if you take into account kind of diversification principles. But this is kind of I think useful information, so kind of whoever is listening to us today can get a sense of what the kind of the marketplace is thinking about the allocations to cryptocurrencies from a portfolio context.
Perfect. That's really cool insight on that one. I guess next question would be, related to a lot of things going on currently, and I know we can't, predict what will ever happen in the future, because let's face it, like no one truly knows what will happen in the future. But it seems like a lot of the common coins that are talked on a regular basis are at or near all-time highs, getting a ton of attention. I don't know. Does it seem like it's like people kind of missed out on the opportunity? I mean, what would you say to people who express that type of concern or have that type of question?
Yeah, I mean, I think part of it with the question a lot of people are asking these days is around just the actual dollar value price, is that it feels inaccessible when you see Bitcoin at what's 63,000, 64,000, Ethereum at 45,000, Solana, or sorry, 4,500, excuse me. And some of these other tokens that are, 10x Solana, Polkadot in recent times. I think a lot of what's sort of misunderstood there is just from a pricing perspective, like the actual price of a token. You should be thinking about it in market cap terms. Like the price that a token is listed at is obviously, it's arbitrary until you know the number of shares or tokens that exist inside of it. So there's been a big push recently for, this has kind of been like the meme or the joke, so certainly not investment advice, of like Dogecoin and these other dog tokens, Shiba and Nu, going to $1. And I think a lot of the idea here is that it feels more accessible to individuals if they can buy something at a fraction of a penny. And I think what you can say here is these tokens like Bitcoin and Ethereum that have a very high price, you can theoretically just have the equivalent of a stock split, start quoting them at a lower price point and then having them feel more accessible. And I'm just trying to really illustrate that the market cap component is what you should really look like. And there is this sort of push to try to redenominate like things like Bitcoin to have it quoted in Satoshis, where a Satoshi being 1/100 millionth of a Bitcoin is less than 1 cent today, less than 0.1 of a cent actually. So I think that's something that people, especially on like the very retail front, they see a headline number and they think it's inaccessible to them. But I think you should be thinking about what is the total value that this could add to the world. And I don't want to spend a lot of time on going into like how you should think about valuing different cryptocurrencies, but you should try to think about how to have a framework for valuing something and not really worry about the price with that arbitrary number of shares.
Yeah, and piggybacking off of that, those are really good points, and it kind of reminds me of, I guess, even individual stocks before fractional trading became more accessible to everyone, where I would interact with people and they would be buying, I can't say a company name, but they would be buying like a low price stock because they had, $100 and they could buy 10 shares of it, not because they actually believed in the investment thesis behind that. Fractional trading kind of opened that up and addressed that related to individual stocks, and the same thing related to cryptocurrencies. So I love that you kind of brought up those points. All right, next question. Any thoughts or ideas on what could be potential future applications for blockchain technology that we are not seeing right now?
Yeah, I'll take that. I'll take that one, Brian. I guess that we're just starting to see the application of blockchain technology and the concept of tokenization in real estate. You know, today, for example, the most prominent example of real estate tokenization is the Aspen coin. Again, not an investment advice whatsoever, but the Aspen coin is essentially a digital security associated with the St. Regis Aspen Resort. And this coin represents, I think, the largest kind of market share within the real estate tokenization space, but it's still a very, very small space. I do think that in the next few years, we're going to start seeing large buildings, real estate assets being tokenized, just because this is really going to increase the liquidity profile of investing in real estate. You know, today, if you want to invest in real estate, we all know that we need to have a lot of money, a lot of capital to back up real estate projects. Once you start thinking about tokenizing, just as it happens with NFTs, for example, or other asset classes, once you start tokenizing them, you start increasing the liquidity profile. So I think that's probably one of the biggest next applications of blockchain technologies that we're going to see in the next few years.
Perfect. And I'll handle the next question because it's related to SoFi. So questions about the factors that SoFi uses to determine what cryptocurrencies are available on our platform. We have an internal policy at SoFi and a specific committee that approves the addition and I guess theoretically the subtraction of coins based on certain thresholds. Some examples of that would be like liquidity, market cap, security, among other factors. So we have an established process, and if you have questions related to specific cryptocurrencies, you can always provide that feedback as well. Cool. Next question from the audience that will go to an expert and not me quoting SoFi policy. Kind of going back to the kind of foundational aspect of it. What's a block and how does that all work with blockchain?
Yeah, I'll take that. The block. Sorry, I apologize if this wasn't clear earlier on. The block is really the settlement layer of transactions on the chain. So there's a lot of different blockchains and a lot of different cryptos. So I'll just again use Bitcoin as an example, not investment advice here. But you know, you have these blocks that are produced every 10 minutes. You have transactions that are produced in real time. Roughly every 10 minutes, there's a miner who's going to mine one of these blocks, and they're going to take all the transactions, aggregate them into this block, and post it to the chain for settlement. So from that point on, you can say that that block settled. Realistically, you want a few more blocks to be mined on top of it for added security. But for low dollar transactions, you can really say it's settled in generally 10 minutes. Higher dollar transactions, you generally want to wait, say 60 minutes on the Bitcoin network. But then like going to some other blockchains, like maybe Solana, Ethereum, Avalanche, you may have blocks that are in a second or a fraction of a second, or in Ethereum's case, 14 seconds. And it's really just the frequency at which transactions settle. So how equity settle T+2, it's like transactions on blockchain settle at the time that a block is actually added to the chain.
Perfect. Next question is something that we do get on a regular basis, and I guess it ebbs and flows depending on what's in the news. Any thoughts or considerations or things that retail investors should be thinking about related to regulation and cryptocurrency as they explore different alternatives?
Yeah, it's a very broad one. And I guess I'll just highlight a few things going on right now without sort of making it a strong legal statement here. I think there's a lot of concern, first and foremost, sort of the Biden White House just put out their piece on stablecoins, I think 2 days ago. So it's very likely you're going to see more regulation on the stablecoin front. They might be regulated more like money market funds in the future or banks in the future. There's also a lot of sort of regulatory uncertainty in terms of what's a security and what's not a security. There's been that rhetoric from Gary Gensler, who is the head of the SEC right now, that a lot of these things are securities under the Howey test. So outside of the scope of Bitcoin, I think it's not totally clear on most things if it's security or not. I think a lot of different people will have their views, but the SEC is not really coming out in advance and saying this is a security, that's not a security. They're sort of playing by the same set of rules that we've had dating back to securities laws in the 30s and 40s, and applying that sort of broad strokes and saying those frameworks apply is what I would say. But it's not totally clear. It's not a ton of transparency here. It's a tough question to answer at this point in time.
Perfect. Next question I'll tackle related to SoFi. Does SoFi plan on adding wallets to our platform in the future? Yeah, to be honest with you, we get feedback on this related to potential roadmap items and features and products and stuff like that we'll add in the future. And ultimately to be something where we have to prioritize that with everything else as far as if and when that'll end up becoming realized. So no firm answer on that as far as timing wise. Next question. There's a question, or you mentioned a couple times today the concept of halving. Can you explain that a little bit for the audience?
Yeah, so that's a Bitcoin specific term, and it refers to what I was referring to earlier with respect to that 21 million supply, where the block reward, which a miner gets paid for creating a new block on the Bitcoin blockchain, started at 50 Bitcoin in 2009, and then every roughly 4 years, I think it's 200,160 blocks, it's going to get cut in half. So then roughly in 2013, you're going to have each block reward every 10 minutes is going to be now 25 Bitcoin, and then again in 2017, it's going to be 12.5 Bitcoin, and it just keeps cutting down. So today it's 6.125 Bitcoin. And in about 2 years or so, 2.5 years, it's going to be cut down again. Yeah, and it just continues like that. And that is sort of what I was alluding to earlier, where it's going to be cut in half every 4 years until in 2137, you're going to have the smallest unit of Bitcoin possible under the protocol rules. And then when you cut that in half again, there's nothing there that meets that minimum fraction.
Perfect. All right, I think we got time for a couple more questions. So if you do have any, please feel free to toss them in the Q&A. All right, let me pick the next one. Oh, there's some questions about the related to market cap of different cryptocurrencies. And Matt, you mentioned that earlier, related to not price, but market cap. I think, can you add some perspective there on like kind of market cap on cryptocurrency more broadly as it relates to, I guess, more traditional markets that we would think of, and kind of touch on that again on how you kind of look at the market cap of cryptocurrency related to, I guess, in place of the actual price?
I guess that I'll take that, but if you look at the universe of cryptocurrencies, I believe the aggregated, the combined market cap of all of these thousands of coins is about $2.5 trillion. If we compare that to gold, for example, we're talking that gold's market cap is about $11.4 trillion. So the crypto landscape is just a fraction of that. And of course, if you start expanding that concept a little bit further into, for example, the universe of investable assets, which is over $100 trillion, then crypto still remains a very, very small portion of the overall allocation, the overall investment around the world, right? So if we compare that to other asset classes, I would say that, yeah, some people would say that there is some upside potential if you look at from those lenses.
Perfect. Next question. How does the usage or adoption of blockchain technology drive the price of, I guess, an associated coin?
Yeah, I mean, I think that depends really. I mean, I'll keep this a little bit high level because it very much would depend on sort of the economic structure of the token. A lot of these things are sort of designed in these game theoretical ways where you want the token to appreciate in price as demand flows into it. But it certainly varies depending on the token structure. I think one example let's just use Ethereum here. Again, not investment advice, just like one token example that I think we've given a lot of Bitcoin examples lately that I think would be good to use something different. Whenever somebody pays for computational power to have a smart contract execute on Ethereum, they're paying Ether, which is the native token on that platform. And a portion of that is being burned, meaning it's just ceasing to exist. It's disappearing from the supply. So if you just think about it from that perspective, it's really just as more demand comes, there's more transactions, and there's more of this currency that powers the computation on this platform disappearing. So it's a very clear relationship there. Some other tokens, yeah, it's just if it's a utility sort of token where you need to buy the underlying token to get the utility out of the platform, it should be very correlated to the demand, right? If you want to use the platform, you have to buy the token. And it's kind of similar to currencies in that respect, that if there's a lot of demand of people flying into one country, you're going to have to accumulate the currency of that country and buy things in that local regime. But that's sort of my corollary. But yeah, it usually is pretty related to the demand for the platform.
Perfect. And last one before we wrap up. So if someone decides like, hey, I can handle the risk, this is part of my my overall plan moving forward on their own, can you describe like the different ways that investors can gain exposure to blockchain or cryptocurrency, and what some considerations for the different methods to gain that exposure would be?
Yeah, I'll take the crypto side, and then I'll hand it to Pedro on the equity side. But on the crypto side, I think without sort of naming names, I think most people are aware that a Bitcoin futures ETF, or at least a few of them, were recently approved. So that's one approach, is just buying the ETF that holds Bitcoin futures. Some of the pros and cons there is, pros is it's pretty simple. The cons is right now there's a high carry cost that you pay a premium to own the future, and as it rolls down to the spot price. But that's one simple way. There's also over-the-counter Bitcoin trusts that you can access, where you can go on your brokerage account and type in the ticker of some of these trusts and just access Bitcoin that way. Pros and cons there is, one, it's very simple and it actually gives you spot price access to Bitcoin. The con, it's pretty expensive, and the structure of those trusts make it so you can't transact at NAV. So you're actually transacting at a market price that can be very volatile, even more so than the currency itself. So you might have to trade out of it at a discount to the NAV of the asset. Other ways to do it is to really just do it yourself. I don't want to represent, or I don't want to say one cryptocurrency exchange is better than the other. Some of the ones in the US are, Kraken, Gemini, Coinbase. You can go to those sorts of centralized exchanges and just buy cryptocurrency yourself. And I guess another way is to just buy from there and then hold it yourself. So buying a hardware wallet or downloading a software wallet, moving the keys off the exchange of Coinbase, Gemini, or Kraken, and taking custodial ownership of your coins. That's another way. So I think that's some of the primarily the main ways on the pure crypto side. And then I don't know, Pedro, if you have anything to add on the equity side.
Yeah, well, very briefly, clearly, if you're looking at public equities that are related to the crypto space and the blockchain technology space, you can also invest through those type of companies. So you can think about publicly traded cryptocurrency miners. You can think about publicly traded hosting services. These are the companies that host mining providers. You can also think about cryptocurrency exchanges, those native cryptocurrency exchanges that enable buy and sell transactions, and now they're more transitioning towards a DeFi type of platforms, and also even equipment manufacturers, right? The companies that manufacture the application specific integrated circuits. Those are kind of the leading components that go within the mining equipment when you think about kind of those applications. These equities tend to have a higher correlation to some cryptocurrencies than the overall kind of equity landscape. So that's another way to get tangential exposure to this ecosystem.
Perfect. And if you're curious to explore cryptocurrency, we have some good free resources on SoFi, so you could check out the SoFi Crypto 101. You can explore the different cryptocurrencies that are available on the SoFi platform. But yeah, I think that wraps us up. Oh, a page dropped that in the chat. I just got that alert, so you could go on there. But that wraps us up for today. Matt, Pedro, thank you so much for joining. Any closing thoughts before we sign off?
No, well, thanks for having us. It was great, very fun conversation, Brian and Paige. So yeah, looking forward to another one in the future.
Yep. Thanks, Brian. Thanks, Paige. A lot of fun.
Perfect. All right, everyone, have a great rest of the week. Thanks for tuning in.